I'm Oliver Sloup with Blue Line Features, coming to you from the Chicago Board of Trade with another episode of Tech Talk. It is Tuesday, July 19th. We've just got three markets for you today. We're going to touch on corn, soybeans, and going to wrap things up with lean hogs before we get into the charts. If you're watching this on YouTube and haven't subscribed to our channel yet, please go ahead and give us a subscribe and a like button. We're just a stone's throw away from that psychologically significant 2,000 mark. I hope we can reach that goal this week with your help. So, without further ado, we'll get into the charts. The first market we've got pulled up here, September corn, and this was obviously in a free fall through the middle of June all the way to the very first week of July. And we started to consolidate, and we laid this level out, or the support pocket out in previous tech talks before really we found support down here. This is previous resistance going all the way back to last fall and the eventual breakout point in January, so the beginning of the year, where we also had a gap. So we filled this gap and are able to defend previous resistance, and now consolidating back and forth as these weather forecasts throughout the Midwest continue to change, and really just chopping people to pieces who are either married to a net long position or even married to a net short position at this point in time. We've moved our bias into completely neutral territory, as we've noted that there's a possibility that there's going to be excellent opportunities, short-term trading opportunities for market participants on both sides. That would be buying the low end of the range, selling the top end of the range. Resistance up here comes in pretty close to 630. That's the 200-day moving average and the original breakout point from the invasion of Ukraine. We get out above there. That's where you know you're wrong, because you could see an extension towards these highs. 660, 670 area, which was the secondary breakdown point here on June 30th. So at the low end of the range, we like the buy side here on corn. A break and close below these lows, though, that's where you tap out. Take your medicine and wait for the dust to settle a little bit at the upper end of the range. We like looking at the sell side, especially for producers who had been wishing that they had some protection on as prices proceeded to fall here over the last month and a half. So that's kind of your target areas to be a little bit more proactive during this seasonally weak time of year for the corn market. Now, moving over to the soybean side of things, we've got the August contract pulled up here, and we have been tethered to the 200-day moving average. That's the yellow line here. I've traded on that 9 out of the last 11 sessions. And again, as with corn, just kind of chopping around, consolidating, and the same with corn. In our daily commentary, we moved our bias into neutral territory, citing the potential of good opportunities, short-term opportunities for traders on both sides of the market. We like the 200-day moving average as a buying opportunity all the way down to the 50% retracement from this year's move. That comes in 1452. 200-day moving average comes in at 1466. The upper end of the range, which we've listed in our morning reports as the congestion pocket, we've tested that yesterday, failed, and obviously didn't get the chance to get up there today. We ran into some trendline resistance. So soybeans maybe look a little bit more weaker, and as we've stated in previous tech talks, soybeans have a little bit more air underneath them when compared to what corn and wheat have done here recently. We take out these lows here, and there's really not a whole lot of support. There's a little bit at 14 bucks, psychologically significant and old resistance, but if that gives way, you could see a run down towards $13. Obviously, weather is going to be an important factor going forward, but just be aware of soybeans breaking below support. There is more room beneath the market compared to what you might see in wheat and corn. Wrapping things up with lean hogs, we've got the August contract pulled up here. We're finally getting a move out above technical resistance, and we've talked about this in several other tech talks, wanting to get out above this 112 level with some conviction. We got out above there yesterday, but it was rather lackluster. You didn't see the follow-through that we were expecting we would have after failing against this so many times. We would have thought a breakout would have some more conviction behind it. Didn't get a whole lot of follow-through today either. Obviously, we had a nice up day, but it really wasn't with the force and fierce that we wanted to see. We really wanted to see this market run on that breakout. Nonetheless, the chart's still constructive so long as we can now defend previous resistance. That comes in about that 111, 112. That also represents a 100-day moving average right at about 110.90. So that's what we're looking at for the lean hogs. Upside potential, a little bit of resistance up here near 114, but really eyeing that 116, 117 area as a potential retracement of this breakdown point from April 25th. Out above there, you're looking at 120 plus. Now, with that said, the August contract, you're starting to run against the shot clock a little bit, so you're going to want to look at some of these deferred contracts if you're looking for a longer-term trade. So that's what we're looking at. That's what you should be looking at too. This has been Oliver Sloup with Blue Line Futures, coming to you from the Board of Trade. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.